Okay, guys, welcome back to Basics, episode 19, where I'm taking my lovely fiance Jessica and teaching her how to trade the stock market. So last week we started on fundamentals. We talked about kind of their strengths and their limitations. Any follow up to that? Any questions?
No.
Again, if you're seeing this on my channel, know that Jessica's got the next channel out there and she's going to start in the next week or so making some of her own videos without me around. So if you're getting sick of hearing from me,
You get to watch the real
you
entertainment.
get to head over there. Give us all follows and everything there. So I left this in as a recap for last one, just talked about how some people use fundamental data, just a refresher that we basically don't use it to make decisions, but we use it as kind of warning systems, as risk management type tools. And talked about the reasons why we don't is because it's not a full trading plan of just saying, I think this is a good company or a bad company. It's not a complete and utter picture. But what we're going to do for the next two is I'm going to show kind of exactly how I use them. And then after these two, we're going to take another episode where we go into trade ideas and I show you where you can find all this fundamental data and what to use, and we'll have you set up with stuff to look at. So where do we focus when we're talking about fundamental trading? When it comes to technical analysis, it's easy because it's just the price chart. You just focus on that and that tells you everything you need. But for this, we need a little bit of terminology and being able to figure out what it is these things mean and what they do, and give you a list of what to focus on. So this is the list we're going to go through today. And the first one's volume. So volume is essentially just a number that shows the amount of actual shares that changed hands today, right? So for example, I've got a chart here on Fossil, and you can see in Trade Ideas, we have that window that I keep saying this is where all the raw data is. And you can see there it's got 348, that's 1,000 shares. And then down below, you can see these bars on the chart that we've never really talked about. Each of the histogram, the blue histogram, each of those is the amount of volume that's done that day. So you can see there's one day here where it had a massive spike in volume. Generally speaking, that means that was some sort of news event day. If you go back on that day and you look through the news, there's probably something in earnings or something that happened.
Okay, I don't understand. So that means the total amount of shares being traded on this stock per day?
Yeah.
Oh, okay.
Yeah.
Okay, that's not the total amount of shares that there are.
No, and we'll talk about that in a second. But this is just the amount of trades, the amount of shares that have changed hands. So it's important because, we've talked about before with the bid and the ask spread that just because the stock's trading at that price doesn't mean that you can get that price in the market. But the more shares that are traded, the easier it would be to get that price. And the bigger you could trade without affecting the price.
Okay.
So you think about it, for if there's 348,000 shares done today and you're trying to buy 100 shares, you're insignificant in the grand scheme of things, right? No one cares about you. You just go in under the radar. But if you're trying to buy 1,000 shares and the company's only done 10,000 shares that day, well, you're 10% of all of the volume of that stock. So then in that situation, your order might be able to move markets. So this is why it's important to check volume, is to make sure that, again, I don't believe there's any predictive value in high volume versus low volume or volume spikes or anything like that, but it's just to make sure that you're trading something that you're going to be able to get in and get out, right? Because the worst thing in the world, and it's happened to every professional trader out there, is being right but not being able to get filled, right? So I buy this stock and then the stock goes up 10%, and I'm like, that's great, but no one's trading the stock and I have a bunch of shares, so by the time I sell, you're flat or even lose money.
Okay.
Right, so that's the main reason that we look at that. And again, it's a simple metric. For the guys out there, I would say anything over 300,000 shares a day is probably good enough to trade. Within Trade Ideas, you can put filters on that. You can say, I don't want to see things that don't do, right? So everything we build for you will have a minimum volume requirement so you don't even see them. But again, it's important to know that with volume comes good fills, and with no volume comes really bad fills. And the next is relative volume. So what relative volume is, and this is kind of complex, but it's everywhere in trade ideas and it's very important, is it basically just takes the amount of volume done right now at any given point in the day and compares it to previous days at that exact time. If you're looking at Apple at noon, and say this chart was taken at noon, each of these is a daily candle, and right now it's doing 0.59 relative volume. That means that right now at noon, if we compare all the other days at noon, it's doing about 60% of its normal volume. So you would consider this a very light volume day where, the amount of shares matter for liquidity. Well, the change in volume matters for actual trading. And it's really just a number of how many people care right now. If you have a very high relative volume move, then you know that more people are trading this stock than normal. So like if you looked at this hammer candle down here and then look at the volume that occurred, this would have been a very high relative volume day. So you may look at that and say, okay, well, that's not only a hammer candle that we like, but that's a hammer candle with a lot of relative volume behind it. So people care is basically the main point behind that. Next is float. And then this is what you talked about before, which was how many shares are out there. So you can see we have that number as well. So for this INSM, there is 89 million shares in the float, which means that, we talked about what is a stock, and it was basically selling off bits of your company to raise money for it. It means they've split their company into 89 million shares, 89 million bits. What you usually see is that shares with a really high float, they require more money to move.
Okay.
So it means that the liquidity is higher. There's more shares out there to transact. So there's usually more shares that just turn over and change hands all the time. So it means any given trade is then less significant.
Okay.
So what people will do is they'll say, okay, people who want big, wild moves, and that's what they're going after, they'll look for lower float stocks because if you look at it in the extreme, if there was only 2 shares outstanding and all of a sudden 3 buyers came in, those 2 shares are going to be worth a crap ton of money, right? Because there's 3 buyers and only 2 shares. And then if there was an infinite amount of shares and a slightly less than an infinite amount of buyers, those shares wouldn't move as much because they can change hands easier. So that's why people will really look at float when they'll say something like, if we go back to Apple has 4.3 billion shares in its float. So there's a lot of shares of Apple that have to change hand in order to cause a really big move on Apple. And each of those shares is worth $300. So the amount of money it takes, the amount of actual dollars it would take to move Apple is insane. You would need billions. This tells us 2 things. Is one, it's a liquidity measure. The more, if you're trying to trade big, which again, everyone should hope to try to trade big eventually, you need a high float because you need that liquidity. But if you're looking for a quick move, if you want to buy something and have it move dramatically quickly, then you're going to look for a low float. You'll play with this and you'll find a number that you like. Maybe you trade those bigger ones and you get bored because they don't move very much, or maybe you trade the smaller ones and you're getting hurt because they're too volatile. And then you'll find an area that makes sense. And again, the beauty of trade ideas is you can say, as soon as you find a float number, you say, okay, I want stocks between this and this. You can just go tell the system to not show you anything else and it will filter them out. So you see how this is kind of 3 lessons are going to be all of fundamental analysis, because you can see it's a protection mechanism that we're using it for. We're not using it to make decisions. We're using it to shy away from certain things.
Okay.
That makes sense. So you're not going to look at something and say, oh, it has a low float, therefore I'm going to buy it, right? You would say, oh, it has a low float, so that means that it's going to move dramatically. Now let me take that into consideration when I'm applying my stop loss or my profit target or things like this. So they're built onto a trading plan. They're not really a pivotal point of a trading plan. You may be out there drawing your lines and doing your charts and you say, this looks like a great buy. And then you're going to go look at the volume and the float and all of this. And one of those things may disqualify that trade. You'll never take a trade because of fundamentals, but you may disqualify trades because of fundamentals.
That makes sense.
Right? So short interest. So then this is one of those things that you would look for and say, okay.
Is it short interest or short float?
Same kind of interchangeable
type
of thing. But this builds on the last thing. So the float is how many shares are outstanding. So right now we're looking at Macy's. And they have 309 million shares out there. 43% of that float is short. So that means that basically half of everyone, and this goes into, I don't think we've talked about it on camera, but we've talked about short selling around the house a bunch.
I had a hard time with that, guys.
It's a lot of people do. But so we talked about how the procedure of shorting is you go to your broker,
right? You
borrow the shares,
right?
You get the shares, you sell them on the market, right? So the broker has to then report 2 times a month. It's bi-weekly. The brokers all have to get together and they have to report how many shares have been lent out,
right?
So a short float of 43% means that essentially about 120 to 150 million shares are out there short. Right. They've lent them out to people. So what that means is that there's so many people out there that the only way that they can get out of their position is to buy. Right? We've also talked about short squeezes.
Right, but I have a question. So if 43% is short, does that automatically mean the other 60 is long, or they're just not doing anything with them?
Well, every share is long, right? Long just means that you have it. You have it, right?
Okay.
So what this is basically saying is there's 300 million shares out there, right? Some are owned by brokers, some are owned by big institutions, some are owned by individuals. But what means is that 100 million shares have been loaned out too short. And it's just the fact that people have to report it means that they have to pay them back at some point, right? You're not really short the shares in the sense that they're not like a negative holding, but what it is, it means that there's shares being lended. And when you lend shares, they have to be purchased to be given back to you.
Right.
And remember, we talked about how the brokers charge a little bit of interest every night that you hold that. So unlike a long position, you can buy Macy's and hold it until ever, right? There's people who have held, General Electric stock and things like this that pay dividends, which we're talking about in the next lesson, forever. They have no intention in ever selling these stocks. The stock just pays them quarterly and they're happy with that. They don't care really what the price is. They just want the company to be healthy and to continue to pay them money. And there's people, that's their entire retirement plans. You can hold long positions forever, but short positions are the other way around. So say, for example, Macy's paid a dividend. Again, we'll go into dividends a lot later. And you're short the shares. You have to pay that dividend to whoever was essentially long it, right? Because they've loaned you the shares, which also means they've loaned you the dividend. Okay. So you have to pay that back as well. So there's basically just saying that you can hold shares forever and there's no detriment to doing it. But you can't short shares forever because there's a couple detriments to doing it. So at some point, 100 million people, unless Macy's goes bankrupt, so at some point, half of Macy's float has to be bought. You have to go to the market and buy it at some point. That could be 10 years, it could be, but it is a finite position. So, and we talked about, so say, for example, Macy's launches some wicked product tomorrow. And it's all of a sudden it's at $5 now, and all of a sudden it goes to like $7 or $8. We know there's a huge pent up demand of people that have to buy.
So wouldn't this be like a style of trading then? Could you not do? Yeah,
I do most of this.
Okay.
I do so much of this because I know. So like if you look at Macy's, we go back and we're off topic, but who cares? It's interesting. If you go back, you can kind of see, I hope, the technical pattern right now on Macy's. You did okay on your test. Let's see if you've studied anywhere since then. It's a descending triangle, right? You've got the lows that are descending, right? And then the bottom is flat.
Oh, that's big.
Right?
See, I have a problem when it's not like right at the tip.
And again, it's an eye thing. You just pick it up eventually. When I look at this, I may say, and this is why I talked about, everything starts with the chart. So I look at the chart and I say, okay, Macy's gone from $15 down to $5. It's gotten hammered entirely, but it's putting in this bottoming formation, which is this descending triangle. Then I go and I look at the fundamentals and I say, okay, well, it traded 35 million shares yesterday. Me getting in and out with 500 to 1,000 shares is nothing, right? 35 mil. I'm the smallest fish in the pond. And then I go and I take a look at it and I say, okay, well, it's got a pretty big float too. So I know there's a lot of liquidity out there. And then I go in and I say, well, look at that short float. So that's when I would get, if I did my scanning and I found 30 descending triangles that I wanted to play, that would be the thing to say, play Macy's over something else. Because I know that there's that potential catalyst of, if the descending triangle causes a pop, then all of these people are going to have to come in and buy, and that's going to, and it is, right? We talked about it with Tesla. It happened last year in Tesla, where it went from like $500 to $1,000 in days, because everyone was betting against Tesla and they came out with good earnings or something, and the thing started rocketing. So you can have companies double and triple just because of what happens here. Because again, the anatomy to you guys, the anatomy of a short squeeze is you get a small move from some reason. So some people are the first to say, okay, I'm going to cover my short, and then that causes the price to move up higher. And then what happens if the price moves up high enough? The broker goes and recalls all of the shares from the other people, saying, listen, you don't have enough money in your account to cover your short position, so we're going to just buy it for you. Like when you join up with your broker, you sign something saying, if we run out of money, you can just come along and buy the shares for us. So then you get this force buying, and of course when the broker's doing it on your behalf, they're not looking for the best price. They're just hitting the market right where it is. They're not being sneaky about it.
Right.
So you get these insane moves out there. If you're interested in this, there's actually in Trade Ideas built in. I showed you that channel bar on the side. There's one that's just called Short Squeeze, and it's a bunch of scans that we built that are just looking for stocks with this high short float, which is something that Trade Ideas does great. But again, that's something with a high short float is not a trading plan. If the company sucks and it's just tanking, then those people that are short are making money, so they're not going to cover. So you say, okay, what's the catalyst that's going to cause people to start buying that will cause this short squeeze? So again, this is not, you don't make a trade based off of a short float, but you might get more excited and you may filter your list down and say, only show me ones with high short float. But then it's back to the chart, back to the candlestick analysis, back to all this kind of type of thing. So that's it for this one. This is going to be what we cover at the end of the next lesson, the single stock window. So if you guys have trade ideas and are just kind of following along with us and you want to get a little bit ahead, you can open up multiple of these single stock windows and you can fill them in with whatever you want. You see, I dumped a whole bunch of data in there. Basically, there's, I think, like 250 filters you can have in there, but that's just a little example that I gave them of what mine kind of looks like, so they can go and check. So I have things like, what's the average volume? Stock twits activity is basically how much are people talking about it on Twitter and that kind of thing. That's it for this one. The next one will be a little bit more of the same, and then we'll get back into the actual program, have you play around a bit more. So stay tuned for those. Any questions?
No.
These are they're not super interactive. They're pretty explanatory, but one more and then we're done.
Okay.
Okay. Talk to you guys next time.